Good evening, everybody. Hope everybody's having a good January evening, if you can have a good evening in January. Anyways, tonight we have the honor again to have Price with us, and I won't even do a long introduction on Price because everybody by now should know who he is. He's been around for years. He's on the big broadcast stations quite a bit, and his stuff is very well known throughout the investment community. So we were fortunate enough to have him come and show us different techniques that he uses. Price has been a very successful trader for years, and so what we're seeing is the real stuff where he's actually using it and making money. And with that, Price, welcome back again. We always enjoy seeing what you have for us.
Well, thank you, Steve, and it's always a pleasure to be here with you and share some of the things I've learned across now 25 years of trading. It says 20-plus years, but I was just counting. I started trading in early 1990s. I think I'm on my 25th year now as we're in 2014 when you start from a zero there in 1990. And literally started from nothing from a trading knowledge perspective. I was hungry to learn trading. All the books I had looked into seemed to be teaching me the wrong stuff. And so basically some of my earliest lessons came from the school of hard knocks. So my goal to share with everybody today is some of the lessons I've learned across really the 90s, the 2000s, and now into the 2010s and beyond as we're moving to the near midpoint of the decade soon. Hard to believe. Certainly want to share, some ways to think about the market that I think you're all going to find to be a little bit different than what the masses might teach you on some other conventional indicators. So we'll talk about, you're here for education. That's what we're focused on tonight. For a lot of my big trend students, I work on into exploration through scanning. We'll take a quick snapshot at current market scans here tonight, at what's happening in the markets right now, and go take a peek at what the indicators are telling us about the market right now. And then ultimately it's about execution. So we do a lot with traders at Big Trends here to have trading workshops and other types of forums where you can constantly reinforce what you're learning in real-world applications. So, hearing it here for the first time is great, and I'll share with you just an unbelievable blowout education offer that we're doing on some last few coaching DVD sets that I have in stock that you'll get a great way to get started with the Big Trends approach tonight. But, it's about the 3 E's. The education gets you pointing your arrow in the right direction towards the target. You first got to make sure you're pointed in the right direction. That's what we're going to focus on tonight. And then you start getting more and more laser focus with the scans and the explorations. And then ultimately when you're aiming for that bullseye right in the middle, it's about you got to have a really laser focus to execute properly. And that's where that happens through repetition. From my point of view, and I am actually on a laptop tonight out of the office. I'm normally in Kentucky, in Lexington, central Kentucky there, but it's a little chilly there, so I'm down in Florida for a few days, still trading from the road with my team, but basically needed to warm up a little bit. So, and it's even cool by Florida standards down here too. But, that's one of the joys of trading is that we can do it from anywhere as long as we've got a good internet connection. So I'll try to jump in and answer some questions a little bit later because I have to just share one screen off this laptop. It all really starts, in my view, with a really good plan. You've got to know where you're going. It's that old Yogi Berra type of phrase. If you don't know where you're going, any road will get you there, right? And we don't want you to be meandering and kind of lost like that. I talked to a lot of traders over the years who have basically been just kind of waking up and trying to read the news and trying to basically react to what's happening in the markets. And I think that's not a recipe for success. You don't want to react. You want to be flexible enough to adapt, but you don't want to be overreactive and thus be buying too high, selling too low, overreacting to the day-to-day news. Yes, some news can be good as we head into earnings season here this month. We'll start to get some good earnings reports coming out over the next week or two. But ultimately, it's about knowing how you want to put a focus on what is your edge in trading. When you think about it, you better have an edge that you're trying to take out of the markets consistently, knowing that there's not a single system I've seen. I don't care how many things you read about that are hyped up out there about how perfect different strategies are, or they say they make money 90-some-odd% of the time. My view of that is that that's really setting you up to basically then think, well, if I'm not making money, then I'll just hold on and eventually it'll come back. That is a recipe to eventually get yourself in a lot of hot water. We want to basically make sure that we're applying our edge, and then when it's not working, we want to cut and run and live to play another day. You know, where you see a lot of really smart people on Wall Street that have gone belly up because they thought they knew better than the market. My goal is to show you today a technical analysis approach, and that's why I talk about having an actual technical system. I believe is the easiest way to actually implement any given edge that we have at Big Trends, because we can test it across a lot of data, but then when we're putting into play in the markets, we know that sometimes it's going to work, sometimes it's not. Our goal is to say, let's really focus on what's working, what's not. Let's see if we can move the slides forward here. And bottom line is, you know about technical analysis by now because you're a fan of Steve Bigelow's, as am I. You know, he teaches you about candle charts, and that's been used for centuries, going back to the Far East. You know, the bottom line is that, we're looking at the same type of an approach here when we go through the power of computers. When I started trading in 1990, my Quotron, I remember that was it seemed high-tech at the time, but now it looks so antiquated because there's so much more that's at the power of your fingertips that you can really take advantage of right now than even a lot of market professionals had access to a decade or more ago. So you really have a lot more of a leveled playing field. A lot of people say, oh, well, the high-frequency traders have an edge. Well, that's not my game. I think if you're trying to trade in microseconds, I think you're going to lose that game against the high-frequency guys. But if you're looking at the bigger trends, at the opportunities where you get a trend kicked off, and those trends can last a lot longer than people expect, that's what I'm going to show you tonight. And it's a reaction to the news that to me is as important or more important than the news itself. So we're going to focus on those continuation trends. We all know that emotions of a lot of market players will tend to impact how many people are selling or buying because of their fear or greed in the markets. And so we want to see where people are maybe selling into a trend that basically tells us that, hey, this is still an uptrend. If it's a little dip in an uptrend, you can get a great buying opportunity. I'll show you some examples of that tonight. Now, what are the three big assumptions, in my view, that technical analysis makes? The first one is that, let's face it, the markets are discounting mechanisms. A great example would be back in mid-December. The Fed came out and said, yes, we're going to start tapering. We're going to start cutting back the amount of money we're plowing into bonds every month. They were only plowing in $85 billion. Now they're only plowing in $75 billion a month. That's led to this record rise in the Fed's balance sheet as they've propped up the bond market to try to keep rates low and, in turn, basically flush money into the stock market and also try to prop up the housing market by keeping rates low. They've done a pretty effective job at that, I've got to admit. But the question is, okay, the market was discounting that tapering in the bond market going all the way back to May of last year. And so once they said, yes, we're going to finally start it in mid-December, the market actually rallied. The stock market went up. The bond market didn't even go down when they said that. They had already discounted that and were actually expecting perhaps even worse. So you've got to realize that, just because you get news, it's the same way with earnings. If you get a great-looking earnings report, but everybody knew it coming in, and everybody bought calls betting that the stock was going to go up and they'd make a fortune on that next rally, well, then basically a lot of times those folks get disappointed because stocks that have already priced in that good news oftentimes drop after that good earnings report comes out because all the buying's been done. So we're going to show you some examples of where we think there's continuation potential or not. Price action does occur in trends. It's because you get this self-fulfilling prophecy that, let's face it, everybody ultimately is watching what's happening in the markets. You've got access faster and faster now thanks to the Internet. And so everybody's reacting to that news even quicker. You're seeing these swings up and down, which I believe makes for a great swing trader type of an environment. I wouldn't say it's a buy and hold environment by any means. I think you've still got to be reasonably active. Perhaps what gains of the last couple of years may spoil some traders to think, oh, well, I shouldn't use such a tight stop because therefore I might get knocked out of this ongoing uptrend. Well, let's face it, that trend's going to change eventually. Your job is to ride a trend while it's in place. I'll share with you my favorite trend indicator, looking at the percent R technique here in a little bit. And then basically your job is to say, how do I keep on that trend while it's active? But once it's not active anymore, once we get a violation, I always say exit first and then come back to play another day. That will keep you from getting complacent and then letting a small loss turn into a bigger loss on the occasional stop outs. Now, also, the third key belief here in technical analysis is the past tends to repeat in the future. Not necessarily with the same stocks. You'll see, for example, the Microsofts and those kind of names that rallied, Cisco that rallied in the 90s, have not basically went through a decade-long sideways move in the 2000s. If you were stuck in those names, you went nowhere throughout the prior decade. But look at names like Tesla, names that have continued to race up this past year. That I'll often say that the names will change, but the patterns tend to remain the same. And so that's because we're talking about human behavior here, fear and greed. When people are making money in an uptrend, there's not much pressure to sell that stock. And so therefore you'll see a lot of these trends continue. A prior example like Las Vegas Sands, which happened to be a very good one last year as well. You can see Las Vegas Sands, if you look at Wynn Resorts, if you look at any of the casino stocks, they had a big year. Well, we're going to show you several examples. This is pulled off of Metastock. You can actually use the big trends indicators off of a variety of platforms. But you can see, if I'm looking at just the percent R rules for starters, Larry Williams developed percent R, which means percent range down here on the bottom panel. Percent R equals percent range. All that means is if you've got a stock, say, trading between, say, $20 and $30, well, that's a 10-point range, right? Well, if it closes at $25, smack dab in the middle of that range, you're going to be at the 50 percentile. You're going to be at the little midpoint of that 0 to 100% range. Because at the high of the range, you're right at 100%. Now, a lot of people would assume if I tell you it's closing at $30 in a 20 to 30 range, they're going to say that stock is quote-unquote overbought, implying that it's at the top of the range, therefore it should come back down. What you'll notice from these charts, however, is that that's actually a very dangerous assumption, and an assumption that actually works a lot better in my experience. So when you see it go overbought, and then it keeps going up, like Vegas Sands did here on the left side of this chart, when it follows through above that first overbought bar's high, that tells me that actually it's not the top of the trading range, but rather it's the start of a potentially big trend. And so we use a variety of indicators to further back up what we're seeing with percent R. But, percent R is, for me, the simplest and easiest indicator when we use it the big trends way to tell us that we're moving out of that choppy zone. See, I don't want you to just trade a tight trading range, a fairly limited amount of opportunity. I would like to rather ride, and my biggest successes have come from riding at least part of a position to its eventual conclusion. I can't tell you how many traders I've talked to throughout the trading space that have told me that one of their big regrets was that they sold a Microsoft too soon in the 90s, or they sold a Tesla too soon last year. They didn't have the conviction to ride that trend as long as they should have. And so what we tend to preach at Big Trends is that once you get on a trend, even if you book part of your profits early, don't book them all, because you'll see what happens here is that every one of these points where it comes back under this overbought threshold, like there on 15th on this left side of the chart, that's not an exit. That's actually just what we call a retest. Every one of those test points basically holds until we get the last, about the fifth or sixth retest over here at the end of April, finally breaks in early May. And when that happens, when that last support, think of it as sort of climbing an escalator or a stair. As long as you keep climbing up, that's a good thing, that the structure is still intact. You can still keep riding that trend. But once that's over, then you hop out. You see in this method, you were never going to catch the exact high or the exact low of a move. I once saw John Bollinger at a conference say that his mentor told him that he was only allowed to catch the exact high or the exact low once in his trading career. And I think that, and he laughed as he said it, and I would agree that it's something that every trader wants to do. Your ego wants to be able to pick the lows and buy low and sell high, but actually you can see in this mode, I'm buying a little bit higher, but I'm actually riding it a lot higher in the good trends. Now, there's times where it doesn't work. So if it doesn't work, you can see, for example, this next signal that came in June on this chart. Look at the bottom panel here. We're just focusing on percent R for starters. I look at a lot of different things. But if you just focus, for example, for starters on percent R, we say, okay, look, when we're zeroed in on this trade here and saying, look, when we get a percent R signal, there it is. Okay, looking for my cursor. You see, there it is, crossing over bot again back here in about the second week of June. When it does that, you see that bar before that, the buy signal, and then it crosses above that high. That's a breakout. But you can see what's not happening. It's not moving outside that upper blue band. That's actually a proprietary band I created called acceleration bands. And so you can see the difference between that move in June versus the move previously in March is that the buy signal is not getting through that band resistance. It's basically stalling up into there. So while that's technically still an active %R signal, this resistance up here is telling me that it's not a true acceleration candidate in comparison. And you can see we got 2 more buy signals on the chart. So after that if you took that signal on %R every single time, you can see that that one is going to eventually get knocked out on a gap down. This is why one of the big rules of thumb here, you're going to lose on that trade if you place that %R only trade without looking at the bands. You're going to lose on that, and I would say that's why you never load up on any one trade, because even for an overall very effective trend-following system like the big trends %R approach, modifying what Larry Williams was doing with a great indicator to just tweak it to our desired trend-following criteria, bottom line is, there's going to be bad signals. And if you load the boat, if you keep doubling down at the blackjack table, eventually you're going to get burned, right? So you've got to make sure that you're only committing. We tend to recommend 5 to no more than 10% of your capital allocated just for that strategy going into each new trade. That doesn't mean of your whole portfolio. So you peel off a piece, and then you trade 5 to 10% of that piece. So it'll keep your risk on any one position, typically ideally in the 1 to 2% of your portfolio range. So that way you're not going to take on too much risk, especially when you use options where we know we can limit, if we buy a call, we know we can limit how much we're going to lose even in an adverse gap situation. But then when we get the gaps in our favor, for example, while you're riding this very long trend on the last one here as we broke out, one of the things I wanted to point out, by the way, is that what I love about the %R approach, the way we've tweaked it and developed it, is when you get this buy signal here, how many of you have had the situation, I can't see the comments right now, but I'll go back and pick them up a little bit later. You've had the situation, I'm sure, where you missed the start of a move. We've all done it, right? We've all basically said, look, if we're, we saw this thing developing, and for whatever reason, we got distracted, we were nervous, had other positions on, you name your reasons, but we didn't participate as it started to take off there in early September. What I love about the retest approach that I was just showing you how a retest occurs is these retests back under that overbought line, we know that that's a critical point within this trend. So back there, for example, about September the 23rd, we know at that low, that little red candle there, remember, one candle doesn't really make a trend, in my view. Steve, I know, looks at a lot of interesting patterns. My view is that, hey, there's a lot of noise on a candle-by-candle basis, but, what happens after that is what matters. So I know I can put a trade on right into that pullback. Yes, it's not going to be as good of a level as the initial buy signal. That was happening at about $33 on that next retest, I call it. But the bottom line is that if it closes below that low going forward, I'm done with that trade. So if you buy an option, say I bought a fairly conservative, in-the-money 30-strike call going out to October or even November. And if I buy in October, I could then put another one on the next test after I book some profits on that next run up here. But then look at the next test, the next retest point that kicks in here. I could move from October. I probably already booked a lot of my profits, but even if I haven't, I'd be trailing my stop up, and that's right into an October expiration. And I'd be adding a position there at about $37, betting on November going on up from there. So each of those retest points becomes a critical inflection point where if it breaks, I'm going to take the knockout. I'm going to get out of the trade. You can see those two retests, September and October, were fantastic re-entry points if you miss the first wave up. This is a vital point for so many of you that have been missing out on the biggest moves in the market. You need to have a strategy that gets you back on the horse, back on the good trends that are working. Obviously, if they're exited, then you don't want to mess with it. You don't want to try to pick a low point. You want to wait for the structure of the chart to set up right, and then you get the next launch. This last one, of course, you got the big gap after an earnings report there in October. And I would say book part of your profits into a windfall gap, but don't book all of them necessarily, because you can see this one kept on going and then finally gave the next test back there in the second week of November, right off this next little pullback under that overbought threshold on the %R. And you see with that low gets taken out a couple days later and says you got to hop out there at about 48 bucks. Now, does that mean that the stock's going to go down when we get an exit signal on the buy signal? No. There's a big difference between a bullish exit and a new short signal. It's just saying that now our edge for the uptrend is now over. Anything could happen at that point. It could go up, down, or sideways. I don't have an edge anymore, so why would I want to hold that trade? So just finishing up the comments on technical analysis, I don't believe that you want to get too hung up on fundamentals for short-term trading. Short-term trades are much more driven by the technical momentum. I'm not necessarily advocating day trading here, but I'm advocating that we don't want to buy a cheap stock that just gets cheaper. We don't want to buy a non-mover, especially for options traders, because we want to focus on things where we have the directional movement working in our favor. So we're looking at price action. We're looking at the volume. How much of a surge are you getting, or some driving factor? It could be driven by earnings. It could be driven by news or the Fed. But we want to look for those catalysts that the %R and the other tools that we teach at Big Trends show you that the trend is really starting to move in your favor. Now, I do believe that past tends to repeat, and our job is to use that pattern analysis, the Big Trends set of indicators starting to line up to tell us this thing is really heating up here, and we want to be a part of those moves. Now, you noticed when we first went overbought, I wasn't buying right there because it could just be the top of a range. I want to know that we're moving out of that range mode, that whippy, choppy action, because remember, in trading ranges, the price action is much more inconsistent, much more unpredictable in my experience. It gets a lot more coherent, a lot more persistent when you start to see what I call a confirmation. So the first step of a bot is what I call the setup point. We're trying to filter out a lot of those potential fake outs, those ones that whip you out and then basically not just cost you money, but also chip away at your confidence. I'm looking for that extra follow-through. I'm willing to give up a little bit of follow-through move to then know I should get on the train because it's really starting to leave the station. I don't want to get on the train and then just sit there for, too long and basically not have it go anywhere, because that's costing me time and it's costing me thus money from an options perspective. So we're looking for those initial indications, kind of those clues. It's like if you were a speed racer and you're looking at that, okay, you go from a red light to a yellow light, and then when that thing goes green, they hit the pedal, right? They don't hit the pedal on yellow. They hit it when it goes green, when you get that confirmation that it's go time. And so what we're looking at here is, okay, the similar characteristics, and again, I'm just kind of warming you up and having you understand some of the initial concepts here in our hour together tonight, and then how we can set up some really simple, easy-to-follow option strategies that now allow you to really leverage intelligently and still manage your risk. That you're not going to try to just be all or nothing on any trade. You're going to seek to create more of a substitute position against the stock on the upside and the downside. The prior example with Research in Motion, the makers of the BlackBerry. This is an example, again, where the first trade was starting to work, and then it didn't quite follow through. You can see we're looking at the acceleration bands on the upper panel now getting violated to the downside in conjunction with the %R breaking down into the bottom oversold area. Now, again, this is very counterintuitive. If RIM, now ticker symbol is BBRY, but if it had closed at, say, the bottom, basically the bottom 20th percentile would have been enough to set me up as a potential trade, but this one closed down at like the 5% level, meaning it closed right near its lows of its range. And you say, well, that's oversold. Shouldn't that bounce back? And sometimes it does, but the really nasty downtrends don't bounce back. Why does that happen? It happens because the range, if you think about it, is actually continuing to stretch to the downside. So if you get a stock that keeps making lower and lower lows, it's going to actually stretch that range and close still near the lower end of that range. So it's a very unusual pattern, but it really shows you these strong trends. And so this first move, it was starting to work on the downside. We got a sell signal back there in about the 54 range because it followed through and closed under that first bar's low the next day. So it's breaking down, and you see then we kind of have a 1 or day and a half bounce, and so from that perspective, then we're working down. We're getting close to that 50 level down here. You could potentially book partial profits into that, but just following the signal through, you see when we get our test, where it comes back up above that oversold threshold right here near the end of April, you can see that high needs to hold as resistance, and it doesn't quite do it. It closes just a hair above it right there and says you got to stop that trade out. Now, obviously, with it being relatively flat over that roughly month that you were in the trade, if you buy an option, you're going to lose money on that trade because it didn't go anywhere. Now, the way to limit that risk is I don't tend to recommend buying the at-the-money option, the 55-strike option when we're right there, 54, 55. I would tend to be more conservative and recommend buying an in-the-money option. Remember, for a put, for those that are new to options, what we're talking about is if I buy a 60-strike put, that would mean that I have a right to sell the stock at 60. If it's at 54, then that option's already worth $6 intrinsically. So you might pay $8 for it, but that means that 6 of the 8's already covered by the intrinsic value. So if it just goes flat like this one did, you might only lose maybe one of those 2 points a time. You might only lose maybe 15% on the option for, say you hold a 2-month option for 1 month. Even if you lost both points of time right into an expiration, you'd still lose 2 out of the 8 points, or basically 25% as kind of your worst case scenario in a flatline market. So in-the-money options are with good intrinsic value and what's also known as relatively high delta. That is, they'll move typically like 70 to 80% for the 1-point move in the stock. You might get 70 or $80 a contract moving in your favor. So 70 or 80% of that move in the stock. And then the leverage kicks in because you're paying anywhere from 5 to 10% of the options cost, of the stock cost in the option. So in this case, the first signal doesn't work. How many times have you done this where you say, okay, the first signal didn't work, so I'm not going to take that second signal. I'm just going to assume, well, it's not working, so therefore the next signal that happens, oh, you faked me out once, but you're not going to fake me out again. You cannot think like that as a trend trader. You have to say every trade is new and unique. You see it breaks down on news there in late April. That was earnings, of course, and then basically it breaks that low, the very next bar, giving us a sell signal there. So the new sell signal in this case happens about $45, and this is one where you see it just stays in this bottom panel percent R indicator. It's close to a retest there mid-May. It does get a retest right into that sold threshold, right into that peak right there. And that resistance right there is going to be your new closing stop. If it closes above that high going forward, you would get out. But you see, it doesn't do that. It kind of goes sideways for a little bit, and then it rolls over again. It goes from about $28, $29 down to about $21 over the next 4 weeks. That's a huge percentage move. It doesn't look like much on this chart because it's already broken so much. But you see, that's where the bottom's falling out for that stock. Of course, REM continued to lag over the next year, even after this initial exit signal back there around $27. So, bottom line is that our technical trend indicator approach focuses on a lot of key pieces. It doesn't mean you have to follow every single one of these, but I look at these because over the years I've found that when I see more and more of these things stacking up in my favor, then I'm really going to know that I've got a higher confidence trade. And ultimately it's about really making sure that you're focused on, the trades that are giving you the best confidence that you can stick with. So I'll tend to combine percent R. I'll tend to combine acceleration bands. I'll tend to look at a lot of other pieces, and now kind of look at these DMI lines as well as the CCI. So a lot of these pieces of the puzzle here you'll see me look at, and they even go into our market timing section here as well. And we'll tell you how you can get a ridiculously good value on my few remaining coaching DVD course sets that we're blowing out here tonight to basically sell the last of them. The last time any of those will be shown in public here, so you get a great way to get started. What I would like to do, though, before I do that is go take a quick look at the current market, because when we go in, and you can do this across, like I said, a lot of platforms. Here's the platform with TradeStation. And you say, okay, go back and look over the last year at what's going on here. I don't want to zoom out too far because obviously you need to be able to see it on your side here, but you can see most all the action's been to the upside with percent R breaking out. And where are we right now? We actually got a new buy signal on percent R yet again. It's been a little choppy here to start off this year, right? We've kind of been up and back down earlier this week, and then we just went back up over the last couple of sessions. So that was a follow through yesterday above the Tuesday high, which was 183.77, closed above that 184.66. So it said buy that close or today's open, which is 184.28. You see, it really didn't do much today, but bottom line is that the bias is still to the upside. We'll look at that percent R test. We'll look at these, directional movement trends, which right now are not very strong. You can see the ADX, average directional movement, trending down. That shows you, it's not as good of a signal right now as, say, in the periods where you saw the ADX trending up, and then getting a nice continuation uptrend, which is one retest back there on November the 7th. So the bottom line on this is that we'll look at all these pieces of the puzzle, and then no matter what type of a trader you are, the daily chart's better if you're more of a position trader. What if you're more of a swing trader? Well, then I would probably go take a peek here at the hourly chart. I'd say, well, we're looking right now here at the percent R breakout technique, and we're saying, okay, just look back, say, not quite as far back over the last 100 bars, and you see right now it's on a buy signal. You see that last buy signal from the Fed was a great one. We got that buy at just under 181 on the SPY, and it trended up to 184 over the next 6 sessions. Right now, we just had a nice little retest this morning. What does that mean? It means there's your breakout yesterday morning, and so that was confirmed up there. And then we pulled back this morning, and that second hour, that low was the retest. Percent R came back under that overbought threshold. What that means is that 183.83 would be your hourly closing stop. The beauty of this, what does a closing stop mean? I'm going through a lot of key indicators pretty fast, I know, but I want you to see what you're missing, even in the current markets. The beauty of this is that a closing stop means that you only check it once an hour to see if it's violated. If it violates, then you just go ahead and get out of the market, move on, clean out that position. So if you're busy during the trading day, or just even if you happen to step away from your computer for a few minutes, you're not worrying about missing an exit, because I'm not going to overreact. I'm going to say, look, I know that 183.83 is my number. So if it closes under that, then the hourly chart will give an exit. Otherwise, that's a great spot to add to a position. It's a great spot to build a position if you haven't yet started to add anything in that particular signal. And it means, okay, now we're just watching this to see what happens, see what we can do with that. Now, if you go into really short-term mode, you could, of course, even look at the 15-minute chart, which is pretty choppy right here, I got to acknowledge. It had a decent little run earlier in the week as we snapped back with a quick little sell on Monday, the rally late Tuesday and into yesterday, and then it stopped that 15-minute chart out. So if you're a quick trader, more of like a day trade to 2-day trade, you'd be waiting until you got into a clearer trend, from that perspective. So don't get hung up on that, you've got to be a quick trader, you've got to be a swing trader. Follow what your particular preference is. And frankly, not just what your preference is for where you think there's opportunity, but also what fits your lifestyle. If you're working a day job and you're checking this education out here with us at night, then I'd say go look at the daily charts and really study opportunities that you can ride for multiple days or sometimes even multiple weeks, and then you just have to check it once a day. So bottom line is there's a lot of different ways to skin the cat, so to speak, and the bottom line is that you just have to see what fits your own particular preferences. Let me go back here real quick and just share with you just a little bit more from the education side. Netflix is a great example of, again, a couple of quick fake outs where if you're trading Netflix, I like to trade Netflix right off of retest points. So let me go back here one second. Trade Netflix right off of these retest points, because what I know is that if I'm wrong on a retest here for Netflix, I don't know what's doing that. There's our pen. Let's go back to our pen here. These retest points, of course, if you get part of your position on the breakdown and then part into the retest, even if you're wrong, you're not going to be wrong for long. You'll keep your risk down. You see it gets stopped out 2 days later for a very nominal move against you. It might have moved less than a point or so against you, and you only lost 2 days of time while you're waiting for that thing to play out. So, from my perspective, yes, it can be worse than that, but the idea is that if we're right in that critical crunch time mode, you're going to see that this thing can really get, a great entry point when you're right, and also keep your risk relatively low. There's always risk in every trade, but so like how do you manage your risk to keep it lower? You can see once this thing goes oversold and then starts breaking down off that third signal in September, I would have waited on that one until we broke the acceleration band at least. And so you see it finally broke that for 2 closes right here, mid-September. and then basically got absolutely pummeled. And this is where then you can go tie in your short-term analysis with that. Now, I'm going to come back and share with you our coaching DVD special that is a phenomenal special here in a little bit. But I want to just, again, remind you that it's about having very clear buy and sell points on your charts here. And when you've got that kind of clarity about where to buy and where to sell, it makes your job a lot easier. Because a lot of people are attracted to trading because of the quote-unquote financial freedom that a trader can have, right? But with freedom comes responsibility. You are the owner of your own trading business for the capital that I know you've worked hard to build up and develop to then be able to trade, but you're also typically the employee in your trading business. You have to be accountable to making sure you follow some type of a rule set. If you don't have rules, then basically you're just floating in the wind. You're going to be overreactive. You're going to be setting yourself up for problems. So what we do is we teach traders how to do that, and this is a separate little example here of our Big Trends Toolkit. It's available in Metastock, TradeStation, Thinkorswim, to name a few. But bottom line is that you can get all those tools at your disposal if you're looking to do it yourself. And the beauty is it just makes our job so much easier. Now, everything that I have shared with you is based around a long history of testing of what has worked and what hasn't worked. And I have to admit, every time I do a seminar, somebody comes to me afterwards and says, "Oh, I've got this great system idea. You should do this, you should do that." And I'll run a lot of those ideas through later and test. Does that actually work? And I've got to admit, even when I've thought there's things that might work, and then basically run them through an actual strategy performance report like TradeStation has, Metastock has, Thinkorswim now has it in their ThinkBack program. You basically will see a lot of ideas that sounded good that don't hold up after looking at them over a large sample of trades. Sure, there's occasional examples where it works, but the bottom line is you're looking for systems like %R here. This is an example with Apple. We tested Apple over a 20-year period here. You can see this was tested at the time from the middle of 92 to the middle of 2012. So you covered bull markets and bear markets, including the financial crisis in 2008. So, covering all those. Now, obviously, Apple was better on the long side than the short side, but overall, you can see even made great money, even with not having to have a super high win percentage. This is something you have to get used to as a trend trader, is that you're not going to be talking about making money 80% of the time or more. That's what appeals to a lot of people I know. But the key here is that you're talking about when you're right, that you can get profit factors of 2 to 1, 3 to 1, or higher. What that means is that if I am losing, say, an average of 20% on an option trade, that this system would be making an average of like 60% on the bullish side. In comparison to the losers, it's making 3 times as much money on the winners. That's how you overcome even, a middling win percentage, is because when you're right, you can really get paid well as an options buyer. If you're wrong, you can control your risk and move on. That will lower your win percentage, but it'll also keep your size of your average loss down. Now, there's a lot of things that I'm going to show you in our coaching DVD special that we're blowing out here tonight. You're getting the benefit of being basically the last group that will be able to take advantage of that, and then will then be gone, because I know Steve's group here, you all are always so hungry for more education. I'm going to give you my most comprehensive package for a ridiculous blowout price. But bottom line is that when we talk about what I want to know the condition of the markets. I want to know if I should be buying calls on a stock. If the market's in a downtrend, guess what? Probably not a great idea to be buying calls on anything, generally speaking, at least related to the market, because let's face it, while a rising tide will lift most of the ships, falling tide will tend to bring them back down too. You don't want to fight that bigger picture market trend. So you'll learn market timing. And a lot of people say, "Oh, market timing doesn't work." A, because most people are bad at it, but B, because a lot of the fund companies don't want you to move your money around. They want you to stay where you are with them so that they'll keep collecting fees on you. I understand that, but the bottom line is timing does work if you actually look at missing the worst 40 days in the market and missing the best 40 days in the market. You would beat the market averages substantially, because when the market drops, it drops a lot faster. You would miss crash-like scenarios. And in our structure, we actually want to show you how to take advantage of downtrends and start learning how to trade put options when the time is right. I'm not talking about trading them every day. We haven't had many puts for quite a while because we've been riding a general uptrend. But that time will come again, and you need to know how to trade both sides of the market. My favorite ETF system, learning how you trade exchange-traded fund key sector plays, as well as key international markets. You can now trade a lot of international markets with ETFs. You'll learn all the key technical indicators, and my favorite option strategies for any market. So you can also, anytime you have a question, you can submit trade examples to me and my team as a buyer of our coaching DVD package. And let me show you that real quick, and then I'm going to go in and look at one more element of the scans here. Let's see, where is that? It should be right here. There it is. So here's what we've done. When I initially launched out my coaching DVD course, I was selling it for more than $500 and then used to never bring it down under $500, basically because people have gotten so much value out of this over the years. The initial price one was $7.95, you can see here. But because basically these are basically the last of this particular batch that we just found, frankly, and the bottom line is that we have about 50 of these sets. And again, this is going to go fast, so I do encourage you to act quickly on it because at this price, $99 for 16 DVDs, you know, that's some insane value. At Big Trends, this is over 15 hours of knowledge that I've transmitted from more than 2 decades worth of trading experience. And you can see the agenda here of what I lay out for you. We had to kind of jam it in there because there's so much there. What's really cool about this is that you're able to take advantage of this, plus email us anytime you have a question about any of the DVD content. Like I said, every one of these loaded with about an hour of content. You'll learn about building your trading plan, the key technical analysis things that I go into more depth on, key option strategies, including some of my favorite more advanced strategies, the multi-leg strategies, the spread trades. One of the most popular parts of this course is looking over my shoulder and showing you trades I made, good and bad, a day in the life of a pro trader. We'll walk you through the key bands, how acceleration bands are useful, and how you can implement them with Bollinger Bands, which I know a lot of you have heard about. You'll learn about efficiency ratio, relative strength, some of the sentiment tools to measure fear and greed, like the put-call ratio and the VIX. And then the most popular disc is actually the data disc. I give you templates with a trading plan that you can build out, with a trading journal you can build out, with a tracker sheet that you can track your positions and know what you need to be focusing on in every trade. All of this for $99. I kind of couldn't believe when they I've been on the road, so basically they priced it down there at $99, so I'm going to back that up. And by the way, that is free shipping in the U.S. I think it's a nominal shipping charge overseas. When you add that to your cart, just so you know, basically you'll see that it's $99. And notice the guidebook this is for the DVD course only. Guidebook is already sold out, but you can get a PDF copy of the guidebook, which is the slides from all the different sessions. So just ask us for that, and we'll be happy to send that over to you too. But bottom line is for 16 DVDs, $99, free shipping in the U.S. If you're not in Kentucky, there's no tax either. So bottom line is that just hit the green checkout button there. You can also now pay with PayPal. I'm going to share with you a little bit of scanning here in a second, so stay with me. I'm not done on the education side, but that's how you just walk through on the bottom, fill out your fields in bold. If you're shipping overseas, I believe it's maybe a nominal charge there. I forget what it is. Maybe $30 if you're overseas. So, but in the U.S. it's $0. Okay. So bottom line is that free shipping in the U.S. and then you can use major credit cards or PayPal. And you know, if you've worked with one of our trading consultants before, give them credit. If you just heard about it here with me, you can just put my name down. Or if you haven't worked with any of them, you can put that too. So whatever works for you. But if you've worked with like I know my lead trade consultant, Chris Sayre, is in with us tonight. You can put him down if he's helped you out. Please give him credit. I like to give credit to whoever helps all of our clients. And the bottom line is that checking the terms and conditions box, which we're very transparent, it's right down there. You can go review all that. It's very clear about what we're all about. Then you can submit the order. We'll get it shipped right out to you. You'll also get access through our member account inside our membership to a lot of other content this way too. So check that out. Now, let me come back for a second and see. I'm sure I've missed some questions from some of you. So let me come back and pick some of those up, and then I'm going to come back in and look at the radar screen here in a second. So basically, then the discount has already been applied there. So just go to that page. I didn't put the link up there. Let me type that in real quick. So it's basically, Chris has probably already put it in there, but it's www.bigtrends.com/coachingdvd. Basically, that link will get you there. Now, let's come back for a second, and I'm glad Chris is in with us. Thanks for helping, Chris. So you can help answer questions there about how people can go ahead and lock that in before they're gone, because they'll be gone fast with only 50 remaining. Bottom line is that radar screen. Let's talk about scanning for a second. There's so much data coming at you and coming at me and coming at all of us these days, and you have to have a plan to scan that data to really pick it out. And now it depends on what kind of trader you want to be. This 15-minute interval will be for the quick trader. If I'm looking for action, I'm looking for something quick, then basically I can pop that 15-minute in. I'll probably be in and out within anywhere from 2 to 4 hours. Maybe I might carry a position overnight half the time with that particular strategy. If we can take the %R scan, and we can say, okay, show me the big movers on the upside. Okay, so I can literally go quickly scan for that and say, well, you can see the stocks that were really strong right near the close today included some of the metals names, not just Alcoa, which obviously is kicking off the earnings season, but FCX and BHP. A couple of movers there on the metal side. Okay, so metals are starting to pick up. That's first note. But I would actually double scan it and double check it with the CCI scan. And when I do that, you're going to see that now we get some of these other names like Kihu and Q-Core. Some of these smaller names are starting to really heat up here as well. That was the biggest move on my list today. Q-Core on the upside, you can see just starting to break out there. So if I looked at that one, that one's not as liquid, although it did trade 6 million shares today. I've got it linked up with all my windows over here. So you see, look at that breakout, how nice it was on the 15-minute %R today. If you're paying attention, folks, again, this one's not quite as active on the options as I would usually look for my options alert services, but there's the breakout this morning at 10:15, high of 55.78, and there's the follow-through, close above there, 55.90. So %R jumps in there and says in the next open, you got to get a piece of this at 55.90. Well, look at what happened. Then it just surges outside of those bands when it goes from 55.90, $56 to over $62, a 6-point move in the matter of a couple of hours. Obviously, the leverage on that with options is even more dramatic. So, you can catch a 10% move. You can pretty much count on at least a 50% pop in the options, even in the money, if not more, especially with that kind of speed of movement. If you were just for, example purposes only saying, well, if you were looking at say if you knew you were going to be in and out quickly, if you were looking at the 0118 call, even conservatively looking at a 50 strike call deep in the money, we're getting that signal this morning. You can see, those options were going from at what time was that? About 10:45. They're at 6:20. You can see they went to $11. Before closing bid 1070. So leverage is tremendous with that kind of a play there. So bottom line is that when we look at all these possibilities, we're looking for strength begetting more strength. I do not want to buy a down stock that's broken. I want to buy a stock that maybe has a brief little pullback. So if I'm looking for a retest scenario, so let's just say that I want to look for the bigger picture trends for a second. So if I format this to say the daily chart, and again, by the way, this is for education only. I'm not telling you to go out and buy any of these tomorrow morning, but I'm saying this is how I run my scans. And I'm saying, okay, if I'm sorting by a couple different key pieces like the CCI combined with the %R, these color codings tell me when something's just gone on a buy signal here like PNC. Other examples would be like SanDisk. Another one here would be AA, Alcoa, and then also Google. Google's been a monster. Even though Apple hasn't done as much comparatively lately, Google, of course, is a great trading stock and one that we like to ride where we can. Well, you go back and look at the daily chart of Google, and you see it's had 2 very nice little uptrends, including the retest that just came in on Monday's market pullback, 1117, and now the stock's popped in 3 days after Monday's close up 40 points, 11. The bottom line is there's tremendous opportunities that you're probably missing out on because you're thinking of the overbought mentality that most people have been trained to say, oh, if it's overbought, I'm going to stay away. Well, that's a mistake. You can see looking at these charts, and you've been missing out. We mentioned Tesla. Look at this monster move in Tesla. Not just the one that's starting to happen again. It's starting to trend again to the upside. But you see what happened last year. 3 different buy signals. The biggest one happened as we went from $48 up to $115, in a month and a half. That was a true parabolic acceleration band signal. These next ones were just %R only, but still that move went from 105 to its exit at 136 6 weeks later. And then the last one that went from 157, peaked out at 194, but then stopped out 176. It was good for about 19 points over about 5 to 6 weeks. So again, and now it's been a little choppy, but it's starting to pick up again. It's starting to actually show some strength with Tesla here. Just came out with earnings, better shipments in the fourth quarter than was expected. It's not as strong of a signal, but it at least has some potential to go back and eventually get back towards the old highs around the low to mid 190s. So, all kinds of potential there. So again, just a reminder, because I don't want you to miss out on this before it's gone, and I'm going to come back in and answer a few last questions. Go to that page that we set up for you. It's bigtrends.com/coaching-DVD. DVD singular, but you actually get 16 discs for $99 with free shipping in the USA. So the bottom line is that you can see it goes through all kinds of quality information. Why am I willing to sell these out so cheaply? Because I know, A, that we're kind of cleaning out the last of this remaining inventory, but B, once you get this information, you're probably going to get hooked as a big trend follower for a long time to come. This has been where a lot of my coaching students have been my most loyal clients. They come back again and again and want other content to keep ahead of the rest of the crowd. You've probably seen the stats that if you educate yourself and get more educated than the masses, when you go through the charts of how much people earn when they graduate high school versus graduate college versus get an advanced degree, the line just keeps going up with more and more education. Does it guarantee you're going to make money in every trade? Of course not. But it does tell you that as you expand your horizons on your education, as you dive a little deeper, it gets to be a lot more potential for you to, take your portfolio to a higher level, and more importantly, learn how to start managing the risk of your trades better and thus keeping more of what you earn. It's not just your good trades that can make you money. It's also minimizing the blow-up trades, minimizing the trades you get stuck in. That's critical to keep you on the right track and hang on to more of your capital and your hard-earned work that you do as a trader. So go to that page, bigtrends.com/coaching-DVD, and lock that in before it's gone. Now, let me see if I've missed a few other questions here. From this perspective, hey, with that special, it's already taken that into account at $99. I can't take it any lower than that. I'm surprised that my team actually took it quite that low, but I'm okay. I'll stand behind it. Bottom line is that, just going back here and seeing, okay, if you ever have any questions, we stand behind all of our products. The terms of service do a great job of looking at that. Brian says, what about the Ichimoku indicator? Hey, there's a lot of other indicators out there. I've tested. I haven't seen enough of an edge from my stuff to tell me that it needs to get added into our tool set. But bottom line is that certainly we're always looking at that. Let's see what else I might have missed here. So what is that website? It's bigtrends.com/coaching-DVD. I think you'll be very happy with it. Appreciate the kind words there, Roy. I see a lot of longtime Big Trends clients in here with us, and we're thrilled to have a lot of new folks as well. So, bottom line is that wherever stage you are in your trading education, I think it's going to open your eyes to a new way to trade that gets you on board the big trends, gets you on the right side of those moves. Stop fighting those moves and start riding the trends. So we do, John, walk you through stop strategies, how we would manage the trades across all those core indicators. And the bottom line is that I think you'll be very, very pleased with it. You do not have to have TradeStation or one of those other platforms I mentioned to benefit from the education, especially at that price point of just $99. The bottom line is that you can really leverage that. Just remember, go to that page here, bigtrends.com/coaching-DVD. And so we'll paste it up there one more time. I'll let Chris answer any final questions, and I want to thank Steve and the entire team at the Candlestick Forum for being, so good to us at Big Trends and helping us share my approach to the markets over the last 25 years. Let's face it, the markets are constantly changing. The names are changing. There will be new names to come, new IPOs. We're getting record IPO activity. So you want to be on the next Tesla, the next new hot stock. The names will change. This will tell you, though, how to participate in that. So take care, everybody. Thanks for being with us. And thank you, Steve, and the rest of the team at Candlestick Forum for allowing me this opportunity to share this Big Trends content with a brand new audience. Take care, have a good night, and we'll see you again real soon.
Don't get stuck on one technique. The reason Price has been around for so long is because his stuff works very effectively. So the reason we have him on is because if you can find something that really fits your trading style or the adding to your type of trading nature, use it and then just apply as much information as you can to make your own trading program. But Price's information has been consistently good. That's why he's been around so long. So with that, Price, thank you very much. I just feel bad for you that you have to stay down in Florida like that. So we'll see everybody in the chat rooms. Have a good evening.